Welcome to vTalkInsight, Market Drivers Daily for December 11th, 2025. Central bank decisions, surging bond yields, and an AI investment wave are colliding right now, reshaping rate expectations, liquidity, and sector leadership across markets. Let's unpack how the Federal Reserve's latest move, the global higher for longer debate, and an increasingly complex AI cycle are setting the tone for portfolios into year-end and through 2026. The first driver today is the Federal Reserve's evolving easing cycle. The Fed has now reduced its policy rate by a cumulative 175 basis points since last September, including a fresh quarter-point cut at the latest meeting. That move fits the pattern investors have feared for weeks, a so-called hawkish cut. Policy rates are drifting lower, but the committee is sending a clear signal that the bar for additional easing has risen and that future decisions will be tightly tied to incoming data. Under the surface, this was not a tranquil decision. The latest cut came with 3 formal dissenting votes, the most since 2019, and several other members indicating they would have preferred either no move or even a larger cut. The accompanying rate projections show only one further cut penciled in for next year, with a material block of officials seeing no change or a possible hike. Futures pricing has followed that tone, now leaning toward just a single cut late next year and very low odds of additional easing before mid-year. At the same time, the Fed has restarted balance sheet expansion through sizable Treasury bill purchases, roughly $40 billion in the first month, and with elevated buying expected for several months. Officials describe these as technical reserve management operations rather than a new round of quantitative easing, but markets are less inclined to draw a sharp distinction. The combination of rate cuts and renewed buying has revived debate over fiscal dominance and the central bank's role in accommodating large government deficits. Market reaction has been nuanced. Equities and shorter-dated bonds rallied on the perception of a more supportive Fed, and the dollar weakened, consistent with a gentler policy path and renewed liquidity. Risk appetite also showed up in precious metals, where silver prices have broken above $60 an ounce as investors position for further easing. Yet long-term Treasury yields have fallen much less, and in some cases remain above their levels before the cutting cycle began, highlighting ongoing skepticism about how far and how fast policy can actually ease. The communication challenge is amplified by politics. The president has criticized the latest move as too timid, calling for a larger cut to support growth, while parts of the market fret that a more dovish Fed chair could be appointed next year with a mandate to push rates much lower. Several potential successors are perceived as favoring easier policy, and at least one leading candidate is linked with a preference for rate hikes now, but faster cuts later. That mix of internal division and external pressure raises the risk that markets question the Fed's commitment to its inflation target if easing accelerates. There is, however, a credible dovish channel. The Fed now explicitly cites rising downside risks to employment alongside still elevated but easing inflation, and has acknowledged that official payroll figures may be revised lower. Recent measures such as the employment cost index point toward renewed disinflation, and policymakers are increasingly comfortable with running the economy somewhat hotter to cushion workers from technological transitions. In that context, modest cuts are framed less as stimulus and more as insurance, particularly for highly leveraged small and mid-sized businesses and middle-market borrowers. From here, the path of the easing cycle hinges on data and leadership. Upcoming labor reports, retail sales, and the pivotal January Consumer Price Index print, with its heavy auto price resets, will shape how much room the Fed feels it has to move beyond this latest cut. Markets are also acutely sensitive to signals around the next Fed chair and whether future bond purchases remain technical or edge toward overt quantitative easing. For portfolios, the key questions are how far curve steepening extends, how durable the support for precious metals and credit remains, and whether today's hawkish cut ultimately tightens or loosens overall financial conditions as we transition to the rate story. Turning to yields, The tightening narrative remains very much alive, even as policy rates edge lower. Long-dated Treasury yields are back near multi-month highs, with the 10-year around 4.2% and the 30-year close to 4.8%, levels last seen in the late 2000s. The curve has steepened markedly, with the spread between 3-month bills and 30-year bonds widening to more than 50 basis points since October, and similar moves are showing up across global sovereign markets. Several forces are pushing yields higher. Growth data and Fed projections now point to real activity running above prior expectations, with estimates of third-quarter GDP above 3.5% and forecast for 2.3% growth in 2026. At the same time, core inflation has eased but remains stuck near 3%, particularly in services, while persistent fiscal deficits are driving heavy Treasury supply. Add in a surge of investment-grade issuance from large technology and infrastructure players funding AI expansion, and investors are demanding more term premium to absorb the flow. Beyond the United States, central banks are also sounding less dovish. European central bank officials, emboldened by stronger activity and firmer prices, now see little urgency for further cuts, and market odds for a euro area hike next year have climbed toward 50%. The Bank of Canada is poised to deliver relatively hawkish commentary at its decision, and in Washington, some market participants are even starting to price a non-trivial probability of renewed Fed hikes next year, especially if a more hawkish chair were appointed or growth continues to surprise on the upside. All of this is feeding a more contentious debate about the terminal rate. Market pricing that once centered on a 3% destination now embeds only about 50 basis points of cuts in 2026, and option markets show growing concern that the endpoint could be higher if inflation proves sticky. The Fed still describes policy as at the high end of neutral and insists that a hike is not the base case, but acknowledges that structurally higher productivity, potentially driven by AI, could also push the neutral rate up over time. For credit markets, the combination of high starting yields and rising supply is a double-edged sword. Some commentators see current yields in the belly of the curve as relatively compelling income versus equities that have already re-rated, yet heavy government and corporate issuance, especially for major tech firms funding AI infrastructure, raises questions about how much more the market can absorb without wider spreads. In property, elevated mortgage rates and chronic housing supply shortages are keeping affordability stretched. Insight suggests that small incremental rate cuts are unlikely to materially improve access for first-time buyers or resolve structural imbalances in housing anytime soon. The counterargument is that recent yield moves are driven more by growth than by an unanchoring of inflation expectations. Despite roughly a 50 basis point rise in 10-year yields since September 2024, market-based inflation break-evens remain close to 2%. Emerging market central banks have also built credibility by tightening and easing preemptively, which strengthens resilience to global shocks. And Fed officials continue to emphasize their 2% inflation objective, with no appetite to formalize a higher target, reinforcing a narrative of gradual disinflation rather than a new inflation regime. Looking ahead, the next phase of the tightening story will be written by data and personnel decisions. The January inflation report, particularly auto price resets, and wage indicators will help determine whether the higher for longer thesis persists or begins to fade. Markets will also track the Fed chair appointment process, Bank of Canada and European Central Bank messaging, and developments in Japanese government bond yields, which have already contributed to global repricing. For multi-asset portfolios, the shape of the curve, the balance between rate and spread risk, and the interaction with AI-related issuance are becoming as important as the level of the policy rate itself, which sets the stage for the AI theme. The third major driver is the AI trend, which has shifted from a simple growth story to a more nuanced mix of productivity gains, heavy capital spending, power constraints, and regulatory tension. Boards still see AI as a core enabler of sales growth and efficiency, but they are confronting real-world bottlenecks in infrastructure, skills, and funding, all of which are increasingly important for equity, credit, and commodity markets. Surveys of senior executives show strong enthusiasm. On average, firms expect mid-single-digit to high single-digit boosts to revenue and profit over the next 3 years from AI, mainly through operational efficiencies. Yet high cloud and model costs, rapid technology churn, and shortages in specialized hardware are delaying full-scale rollouts. Many chief financial officers remain reluctant to entrust critical processes entirely to AI. An early labor data hint at slower hiring for new graduates in AI-exposed fields, even as more experienced workers see stable or better prospects. Despite prominent headlines about automation and layoffs, the macro labor signal from AI remains modest so far. Unemployment claims are still subdued, and more than 60% of surveyed firms actually plan to increase headcount by around 4% in the near term as they invest in AI capabilities. On the productivity side, some deployments are already delivering striking gains. One large financial institution and HSBC, for example, have rolled generative AI tools out to roughly 170,000 employees, reporting that code vulnerabilities can now be identified and patched about 10 times faster than a year ago. In financial services, AI is rapidly becoming embedded in fraud detection, compliance, and client service workflows, and major banks like JP Morgan are planning over $100 billion in spending next year, with AI a significant component. Regulators are responding by stressing the need for human oversight and encouraging the use of AI sandboxes, controlled environments where firms and supervisors can experiment safely. Even so, only a small fraction of companies report having robust defenses against AI-driven cyber attacks, and the Pentagon is already preparing for scenarios where adversaries leverage both AI and future quantum computing to target critical infrastructure. Corporate case studies highlight both winners and laggards. GE and its energy spinoff have raised profit guidance, doubled dividends, stepped up buybacks, and highlighted AI data center demand and electrification as key drivers behind expectations for a doubling of their backlog by 2028. By contrast, Oracle's aggressive push into AI infrastructure has come with a jump in capital expenditure from $8 billion to $12 billion and a swelling cloud backlog above $500 billion. Its shares have nonetheless struggled as investors question how that build-out will be financed and whether returns will justify the scale of debt and potential dilution needed. AI is also reshaping energy and geopolitics. Surging power needs from data centers are driving investment in off-grid, gigawatt-scale natural gas generation projects, particularly in regions like West Texas with abundant fuel and supportive regulation. In Europe, where hyperscalers are scarcer, AI exposure increasingly runs through energy infrastructure, grid efficiency, and networks rather than pure software. Abu Dhabi is positioning itself as both an AI adoptee and a global asset management hub, leveraging capital and technology to attract talent. U.S.-China tensions add another layer. Chinese firms such as Alibaba and ByteDance are seeking advanced U.S. AI chips whenever export rules permit, while reports that DeepSeek obtained restricted NVIDIA hardware through third countries highlight enforcement gaps. Congress is debating tighter controls on chip exports and tracking, even as U.S. political parties diverge on broader AI regulation, from consumer protection and deep fake rules to competition policy. Meanwhile, institutional investors like Canada's largest pension fund are increasing exposure to AI bellwethers, such as NVIDIA, underscoring confidence in the theme despite mounting worries about valuations and potential bubbles. At the macro level, AI-driven productivity could eventually support higher sustainable growth, and central bankers have begun to cite elevated productivity as a reason the economy can run hotter without sparking runaway inflation. However, AI also boosts demand for energy and specialized services, so its net effect on inflation is ambiguous and may keep price risk skewed to the upside. Key watch points now are evidence of monetization and cost discipline in AI-heavy earnings reports, the scale and pricing of debt issuance for infrastructure, regulatory moves on chips and competition, and the pace of new power projects. together with the rates backdrop. Those factors will determine whether AI remains a tailwind or becomes a source of volatility for markets into 2026. To sum up, the Fed has delivered another cautious cut that tempers hopes for an extended easing cycle. Long-term yields are signaling that higher for longer remains a real risk, and the AI boom is evolving into a capital-intensive, power-hungry, and increasingly regulated ecosystem. Investors now face a landscape where the shape of the yield curve, the funding model for AI infrastructure, and the policy choices around both inflation and technology regulation could all drive cross-asset performance. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.